Good morning, everyone. This is Paula White, and I will be doing the lecture that's recorded for week 2 of Accounting 101. And we do have one person on with me today, and she'll be, so far, being representative of all the other cohorts about questions, and hopefully she won't be shy in asking, because week 2 is a critical week in this course to not get confused about. I just want to reemphasize what I told you all last week. And live sessions occur on this schedule. Today is Tuesday. I couldn't do my live lecture on Monday because it was Memorial Day holiday. So this Monday got changed to Tuesday, but yesterday Jeannie Goodwin did her 3:30 p.m. session. Today, Wednesday, Natasha Robinson at 11 a.m. will be doing hers. Wednesday, 6 p.m., Matt Thomas. Thursday, Richard Zollinger. And Friday at 9 a.m. will be Carrie Litt. How these sessions are scheduled is the first one, which in this course would be mine, will be the actual lecture, 60-minute lecture that's recorded. Then all the other sections, from Jeannie down to Carrie, all these other sessions are sessions that you pop into. You could stay for the whole hour if you choose to, but it's to ask questions. I don't understand how to do this. When she said this in the lecture, what did she mean? I don't understand this part of the chapter. It's those type of sessions to help you get past any confusions you may have in the course for that particular subject, or to even get past that part of the homework. These are all faculty that are currently teaching this same course. You also have the option of going with Marianne Stratford, who is with your SHARK team, your SHARK Student Success team. And this is her schedule. And this is more the tutoring sessions. Tuesday, 4 to 8, Wednesday, 4 to 7. Also Thursday, Fridays 4 to 10, and Saturday is 5 p.m. to midnight. And she says here, we are here to help you succeed. And that is exactly what we all are here for. Let's see. Yes, Matt is teaching 102 this month, but I think he is also teaching 101. So let's see. Thank you, Nancy, for adding that. Let's see. Let's continuing on. So today's agenda, we will be covering Chapter 3. Last week we covered Chapter 1 and 2. Then I have a practice problem to walk through. And then we will go over the homework assignment. And that homework assignment, I will even walk through 1 or 2 of the questions with you, actually helping you out on those. And then we will open it up for questions. But Nancy can certainly, she's the only one on right now still. And as she asks questions, I will stop at that moment and certainly answer the questions, because I want this to be an understood and very understandable session and open for comments and questions. Excuse me. Okay. So I do want to remind you first, before we get to Chapter 3, that there are mega lectures, and hopefully everyone's been able to find those. Basically, you just go into the course resources, and toward the top, it's mega lectures, and I think there were 2 for last week, and there's 1 for this week, and it basically is a short usually less than 15 minutes, very specific, very driven lecture on the course material. And then you have this online session that I told you about, and this session is recorded. Let me check that, make sure it is. Yes. This session is recorded and would be posted to your session by your instructor. The discussion forums are ways to earn points. Many times I see folks not even participating in them and then wanting them to do them at the end, which gets them drastically reduced number of points available. So do not drop points by being late in your discussion forums. Initial post is due Wednesday, midnight, Mountain Time. And 2 response posts at least are due by Saturday, midnight, Mountain Time. I always hesitate when I say Mountain Time because I'm Pacific Time. I just have to remember which time zone Independence University is. Daily checkpoints. Those are those daily quizzes. Do not miss taking those. They are only available midnight to midnight on the day that they're open. So there's no making up for lost time by doing checkpoints on different days. You only have one option for one checkpoint each and every day of this course. And do your homework. A lot of times to do your homework, I want to remind you, it becomes a lot easier if you keep current with the class. And it's not a course that you can complete over one weekend in week 4. Please read the textbook, then watch the mega lectures. Keep up with this course daily. Don't lose points for late work. Participate in these online sessions. I had one person last week, and I have one person right now. Please participate in these online sessions. It will help you succeed in this course. And also remember that the Student Success Team is here to help. Okay, so now today we're going to do Chapter 3, and then we're going to have a practice session. So if there's no questions, I will continue and start that. Okay, let's see, I have a question. There was a lot of confusion last week for this was, okay, this is your first mega course. And you didn't see the lecture from last week because it wasn't posted. Let me fix that for right now. I'm going to go into the class. So if I go into week 1, this is week 1, right? So I'm just going to page up a little bit to the course home section. And here's where you have your book, but here, mega course lecture videos. Click on there. And this is where your lectures are. The very first one talks about the format of this course. And then there were 2 of them just for understanding what accounting is and the rules, and transaction analysis. So these 2 would have been helpful to have watched if you had known that they existed. Now in week 2, we have debits and credits and analyzing with T accounts. So that's what we're going to talk about today. So this is a little, I'll click on here just to show you how long it is. It is spinning around. It's 13 minutes long.
A key concept you're going.
So it talks about the key concept, but it's 13 minutes and 54 seconds long. It's an excellent resource for week 2. Week 3 has its own, and week 4 has its own. So it's always suggested to read the textbook, watch these mega lectures, and then participate in the online sessions. Okay, so you were missing the live lecture. I will fix that, and I know that was probably a little bit disadvantageous, but it will be fixed this week. I will contact your instructor. So let me continue with Chapter 3 PowerPoint. And I'm going to move you up so I can see when you type in questions. Okay, so Section 1 is all about transactions that affect assets, liabilities, and owner's equity. And the objectives here is to set up something called a T account for assets, liabilities, and owner's equity, analyze business transactions and enter them into these accounts. It's just an account structure. And then determine the balance of the account. Let me check. Okay. So, I believe we learned last week about the accounting equation, that it's assets equals liabilities plus equity. A equals L plus E. And it kind of makes sense that assets are property that a business owns or controls, and that property is either owned by the owner themselves or a combination of the owner, and if the owner created debt in order to pay for that asset, then it could be partly owned by MasterCard, Visa, American Express, the bank. If the bank loans you money as a business, it could be a loan from your family. Anything. Liabilities are amounts of money that you owe other people. So if you bought a car for the business and you paid, let's say, $2,000 down, $2,000 would be part of the owner's equity, and the remaining value of the car that you paid, let's say it's a $20,000 car, $2,000 you paid down, you owe the bank $18,000. So the car would be 20 equals 18,000 liabilities plus 2,000 owner's equity. And basically everything, this equation never changes. This is something you can hang on to forever. Assets have to equal liabilities plus owner's equity. It's an absolute. Now we're going to draw T accounts. And there's nothing more magical to them than they look like a capital T. Do you see that? And look, assets, the underline under the word assets and the vertical line going down looks like a capital T. So right now I see 3 capital T's on this slide. Each T account has a left side and has a right side. And that makes sense because there's 2 sides to this T. There's 2 areas underneath the capital T. And for assets, this is something that you just have to accept and something that you just have to memorize. Under assets, assets are increased by the left side of the T, while the right side of the T increases liabilities, and the right side of the T increases owner's equity. So consider this equal sign a dividing point. Kind of like, what they say on a mountain at the continental divide, at the point of the mountain where it's at the very tip, when water falls, if it falls on the left side of the continental divide, the water will go to the left. When the water falls on the right side, the water will go down to the right side. Same kind of concept here. Here is the increase for assets. Here is the increase for owner's equity and liabilities. They balance because the left side has to equal the amount on the right side. Assets will equal liabilities plus equity. And where we're going to go with this, in the example that I talked through earlier about the $20,000 car, well, you have an asset of $20,000, so $20,000 would be here on the left side of assets. $18,000 loan would be an increase to liabilities because you didn't have that loan before, so it would be on the right side. And owner's equity, the actual $2,000 down payment would be on the right side. So the left side has $20,000, and the right side for liabilities and owner's equity has $18,000 plus $2,000, or $20,000. Your equation is still in balance, and the left side of the accounts have the same balances in them as the right side of the accounts. And we'll just continue to move on. I'm going to check to make sure that Nancy's okay with the T accounts as they're presented at this moment. Are you good, Nancy? She says she's great. Thank you. That's great to hear, because you're my feedback for the other students. Okay, so the effects of business transactions. We have steps to analyze the effects of business transactions. One is to analyze the financial event, and that's kind of what we were doing last week. And with the homework. Identify the accounts affected. Classify the accounts affected. What accounts do they go to? Like, we knew that the owner last week put $20,000 into the business as her investment. So we knew that the accounts were going to be capital and cash. Classify them. Well, capital is equity and cash is assets, because we had to figure out how to classify them, and determine the amount of increase or decrease for each account. So that's the important beginning part still. Now we have to add to it, apply the left side, right side rules for each account affected, and then make the entry inside of that T account form. So let's see what this continues. In account balance, there's a difference between the amounts recorded on two sides of an account. Okay, the account balance is the difference between the amounts recorded on two sides of the account. We'll see what that statement really means in a couple minutes. A footing is the small pencil figure written at the base of an amount column showing the sum of the entries in that column. It's just a little subtotal that we put in. So I'm going to go to here for the moment. When I said that the account balance is the difference between the amounts in the column. What I meant is, here we have liabilities as an example. $2,500 on the left side, which reduced liabilities, and we have $6,000 increase on the right side. So the liability, the accounts payable account, we're not going to do a total for each side of the T account. Instead, we have to say, well, they have a $6,000 credit and a debit of $2,500. So what's the difference if I take $6,000 minus $2,500? I will get a credit balance of $3,500. $3,500 is the balance of this account. Likewise, in cash, cash gets increased on the left side because it's an asset and decreased on the right side. We have a footing here. Remember, a subtotal of the amounts in that particular column. This is a footing. So all the amounts on the right side of the cash account, which represents reductions, these are checks that we've written, total $17,000. We have a $100,000 amount on the debit side, which is the increase side. So we increase cash by $100,000, and totally we decrease cash by $17,000. So the balance in the account is $83,000 under the increase side. Over here, we put the balance here under the increase side because $6,000 is bigger than $2,500. The net has to go here. $100,000 is greater than $17,000. The net has to go over on the left side. So Nancy, are you still great? Yes, good, thank you. And she will certainly tell me when she's not. I'm depending on you, Nancy. So now let's look at this recording the account balances. If the total on the right side is larger than the total on the left side, like accounts payable I just showed you, then the balance, the difference, is recorded on the right side. If the total on the left side is larger, the balance is recorded on the left side. This is what I just showed you with cash. The first one is what I showed you with accounts payable. That's all these first two are telling you. If an account shows only one amount, then that is the amount. That amount is the balance in the account. Because there's no other transactions in that account. And if an account contains only entries on one side, then the total of those entries is the account balance. And you keep that account balance on the same side that those entries are on. So I think we're good with cash, and we're good with accounts payable. Here, Carolyn Wells Capital only has one transaction, so that's all she has in this account. So that is the account balance. Supplies has only one transaction to it. It's on the left side, so that is the balance in the supplies account. Same with prepaid rent. Now, equipment has two entries, so the total on the left side is the balance in the account, because there was nothing on the right side to have to subtract from it, like we had to with cash. So hopefully that makes sense. And then we're summarizing all of the account balances. We're just putting in and reminding ourselves that the accounting equation is assets equals liabilities plus owner's equity. So we took cash balance, $83,000, and put it under assets, because this whole column of accounts are asset accounts. So first line is 83,000, second line is 1,500, third line is 8,000, followed by 11,000. So those are the four numbers here, and we're going to add them up, and it's $103,500. Liabilities is, there's only one liability account, and that's $3,500, so we put $3,500 here. And owner's equity only has one account, so we have $100,000 and we put it here. So total liabilities is $3,500, total equity is $100,000. Add those two up, you get $103,500, and that does equal assets. If this was not the case, then you made an arithmetic error. Maybe something was put on the wrong side. Something is wrong if assets does not equal liabilities plus owner's equity. It always has to equal. Okay? So let's move on to section 2, transactions that affect revenue, expenses, and withdrawals. So we're going to set up T accounts for those two account categories, revenue and expenses. Then we're going to prepare something called a trial balance from all of those T accounts. It's just a report coming from those T accounts. And then from that trial balance, we're going to do an income statement, a statement of owner's equity, and a balance sheet. And then we're going to develop a chart of accounts. Okay. So these are the rules of debits and credits. A debit is an entry on the left side of the account. So in our previous exercise, where is it? Here, a debit is on the left side of the account of each of the T accounts. So debit is here, debit is here. Let me see if I can get a pen out. Debit is here. I'm going to say it's DR. A debit is here, DR. And a debit is here, DR. In our industry, DR represents debit and CR represents credit. I think back when the Tibetan monks were developing the double-sided accounting system, it was really called debitor and creditor accounts. We shortened it to debit and credit, but the R stayed with the debit and credit shorthand. So anyway, do you see where a debit would increase an asset, where a liability would be decreased by a debit, and owner's equity would be decreased by a debit? Okay, so now we're going to also introduce a concept of credit. A credit will be on the right side of the account. Consistently, like debits. Excuse my artistic endeavor here. I'm doing this with a mouse pad, a finger pad mouse pad. So on my right side will be credits for each and every T account. So no matter what, debits to the right, debits to the left, credits to the right. In fact, I think you have a wrap video to listen to for your discussion this week that says debits to the left, credits to the right. This is exactly what we're talking about. And if debits increases assets and debits decreases liabilities and owner's equity, just the opposite will happen with credits. Credits are going to decrease assets, but they're going to increase liabilities and owner's equity. Do you see the pattern here? I'm going to ask. Oh, she had a question. Never mind, I answered it. So does this pattern, the pattern is something you have to memorize. Does this now make logical sense? She says it's starting to. Well, put something like, I'm sure your textbook and the little video, the mega video, covers this also. So draw your own pictures, and you're going to have many different ways of memorizing debits and credits. But stay with one that makes sense to you, and all the other hints on how to remember debits and credits, you're just grabbing onto one. But I'm just showing you here how visually it's set up. Debits are always on the left side, credits are always on the right side. Assets always has to equal liabilities and owner's equity. And assets are increased on the space on the left. Since assets are on the left here, they get increased on the left. Then on the other side of the continental divide, liabilities and equities will get increased on the right side of the account. And if one side increases, the other side has to decrease. Okay, she's still speaking to me. Okay. So let's see. I'm going to get rid of this pen for a moment. Clear. Clear my drawing. Okay, let's go back to where we had been. This is a big week in this class. Okay, so a debit is an entry on the left side of the account. Debits to the left. Credit is an entry on the right side of the account. Credit to the right. It's that rap song that is part of your discussion forum this week. Double-sided entry. A double entry system is an accounting system that involves recording the effects of each transaction as debits and credits in separate accounts. Hopefully that's starting to sink in and make sense. So every transaction in a double entry accounting system has at least one debit and one credit. And that should make sense, because how else can you have the accounting equation equal unless the debits are equal to the credits and the assets are equal to the liabilities and equity? So another rule that will never change is that every entry will have at least one debit and one credit. And that leads us to that every transaction must have at least one debit and one credit, and the total of the debits and credits recorded in separate accounts for that entry has to be equal. My example of a $20,000 vehicle purchase, $20,000 equaled the $18,000 borrowed from the bank as well as a $2,000 down payment from the owner. 20 equals 18 plus 2. The amounts on the left side equals the amounts on the right side of the accounts. The debits equal credits. We have a balanced condition. Okay. So any account, the left side is a debit side, and the right side is the credit side on any and every account. So accounts refer to the left side of the account as the debit side. So we're not saying left side and right side. That was a baby step to get us to actually talking the language of accounting, which is debits and credits. Debits are always left, and credits are always on the right side of the account. The right side of the account is the credit side, the left is the debit side. Okay. This is another visual, and it shows that assets, liabilities, and equity, we have debits, increasing it. The yellows are the increasing. Debits are increasing. Liabilities are credits because they get increased on this credit side, and owner's capital gets increased on the credit side. And we've covered assets, liabilities, and equity pretty thoroughly already. Inside of the owner's capital account, there's also 3 other accounts. Because as the company makes money, the profit of the endeavor is going to be part of the owner's capital because the owners own the income also. As money is made by the business, that's the owner's. And when the owner takes money out of the business to pay his or her personal expenses, it's not an expense, it's a draw, an owner's drawing account. That's where owners remove money from the business so they can live on. They can make their own rent payment, their own shopping spree. They can go and buy groceries. That has to come from money somewhere. They work for the business. The business is a sole proprietorship. So when they take money out of the business, it's not an expense for the business. It's a draw, which directly reduces the capital account. This is where she puts $100,000 in, and this is where she needs to take $10,000 out to live for the month. And then revenue accounts are credit accounts. That's where you actually, if your business is to sell, every time you make a sale and every time you make a sale, it's going to increase a revenue, and the revenue is going to be a credit. And every time you have an expense to support that sale, it's going to be a debit. Right now, I know I'm talking just probably the Greek language to you, but let's make sense out of this. If these 3 accounts at the bottom are all part of special accounts within the equity section, within the capital section, and the capital gets increased with a credit, when the business owner takes money out of the business, it would be a debit, right? If they put money in and it's a credit on the right side, by taking money out, it will be a debit on the left side. So that's why the owner's drawing account will be a debit account within the capital group of accounts. Okay. Then net income is part of the capital account also. Revenue minus expenses is what net income is. Revenues less all the expenses incurred. So if net income is an increase to the capital account with a credit, and so the revenue would be an increase to net income, so it would also be a credit balance account because it has the impact of increasing net income, and increasing net income would also be an increase to the capital account. But all the expenses that had to be incurred to contribute to net income would be a reduction to net income, and therefore a reduction to the owner's capital account. So expenses would be similar to owner's drawing account, which would be a debit. So capital accounts are credit, increase with a credit. Revenues increase capital accounts, which would be a credit balance. And the drawing account would be a decrease to the capital account grouping, as well as all the expense accounts would be a decrease to the capital account grouping. And let's see if there's a different way of looking at this. Oh, okay. So this is where people start having little games that they're playing with. How do I memorize debits and credits? Okay, got a question. Okay, what gets confusing is it says a credit is a bill paid on the liability side. A credit. Okay, we'll go over that when I go over some of the things in the homework. What gets confusing is it says a credit is bill paid. Okay, if you have a bill, an invoice from a vendor, basically you have an expense or an asset. Let's say it's an asset. You bought something at Office Max and you charge your MasterCard for it. So you have a debit here because you have new office supplies, and you have a credit here to MasterCard because you used it to pay for your office supplies. Now when you pay this bill in the second transaction, when you pay this bill, the bill's going to go down because you're going to debit the liability, and you're going to reduce your cash by crediting cash. So cash will go down, and the amount that you owe will go down when you make the payment. But this is as she says, usually when people pay a bill, it is a debit to them. Yeah, when they pay a bill, it is a debit. Yeah, please, can you unmute? Yes.
What I'm saying is I mean, I understand that the assets equal liability in owner's equity, but when people are just like looking at an equation, they're not thinking the assets on one side of the equal sign. And it's hard for me to explain what I'm saying, because when I first started in all this, I was like, oh my gosh, we're paying stuff. How is that an increase, when it's actually taking money away from the company when we're paying our bills? That's what I would.
Oh, okay. So,
okay.
Yeah, keep your thing on, because an asset, one of the accounts in the assets is cash. One of the liability accounts is accounts payable to whoever you're owing money to.
Well, what is just getting confusing is the double entry of it.
Yeah.
That's what I'm saying is the confusing part, because some people are not going to realize that when you add to one side, you have to take away from the other.
And you certainly do. And I also think one more thing is people have credit cards and they have debit cards. And a debit card reduces their checking account immediately. So they don't
see it as a credit.
Yeah, because basically, yeah, when a bank gets you their, when you get your bank account statement every month, and they take money out of your account for service fees, it's a debit on that statement. And here I'm trying to tell people that cash is increased with a debit. Well, how can that be?
Yeah, that's what I'm saying is the confusing part of it for people.
Right. So how that is for the bank, let's say this is the bank's ledger right here. When you drive through and deposit your checking account, your paycheck for the week, the bank will increase their cash, and they will increase a liability account in the name of your name, because they owe you that money. So whenever you use your debit card, they're actually debiting their liability account in your name, which you think is your checking account. It happens to be the bank's liability account.
That makes more sense. I mean, I understand it as a process, but I mean, it doesn't always come across that way.
I know, and I think we've been trained by the banking system because they keep sending us their liability statements, and we think it's our bank statement, and it is our bank statement. We just have the other side of it. It is our asset. It's their liability. So they've trained us our entire life that credits are good because they increase our checking account, and debits are bad because they decrease our checking account. But really, it's the credits are increasing their liability account to us, and the debits are decreasing their liability to us.
Thank you.
And it's confusing. It's totally confusing. So good. Thank you, Nancy. Let's continue. Okay, so a trial balance is, I kind of say it's a try and see if it balances report. You use a proper heading to include who, what, and when information, and we'll see one in a minute. List the accounts in the chart of accounts order or in the same order that they appear on the financial statements. Enter the ending balance of each account in the proper debit or credit column. Total the debit column, total the credit column, and compare the two columns, and they have to be equal because debits have to equal credits. And excuse me, this is what one looks like. One, it's all the list of the accounts, and here are the assets: cash, accounts receivable, supplies, prepaid rent, equipment. And you see that they have debit accounts, debit balances to those accounts. Accounts payable has a credit balance, as well as Carolyn Wells Capital. The drawing account, fees income, and salaries and utilities expenses. So this is what a trial balance is. And if you don't have these in balance, you've made a transposition error of some sort, you have an addition error, or you put one side of the account in and you didn't put the other side of the account in. Oops, let's go back. So this shows you that In the income statement, let's go backwards. I like to go backwards. I'm left-handed. Carolyn Will's capital account has $133,350 in it. That includes her beginning balance plus net income minus her drawing account will get $133,350. The net income here comes from fees income and salaries and utilities expense. So fees income increases capital because it increases this number, which increases this number, which increases this number. Expenses decrease net income, which decreases owner's equity, and therefore this number. So those things are opposite, and the drawing account is also a decrease to the owner's equity account, so it will have a debit balance. So now let's go to, how are we doing on time? Pretty good. Okay, let's go to this. Down here are the actual, let me get a pen out. Okay, down here are our accounts. From here to here. So those are the accounts that we can use, no more. So let's say number one actually says owner invested $18,000 in cash in her business, because we're not talking corporation here. So we're going to increase cash, and we're going to increase, this is capital. We're going to increase cash, we're going to increase capital, which is equity. We hired a secretary receptionist at a salary of $375 per week, payable monthly. There's nothing to record. We hired her, she hasn't started working yet, and we haven't paid her yet. So in accounting, we don't have anything to record yet. Just know that we hired a secretary receptionist. We paid office rent for the month of $900. So we're reducing cash, and we have rent expense that we're increasing. So cash will be reduced with a credit, and we're going to debit rent expense. Purchased architectural supplies. So we're purchasing supplies on account. Whenever you see on account, that means if we purchase it, it's going to be on an account payable. That's an account that you need to pay. The difference between an accounts payable and accounts receivable is accounts payable are the amounts that we have to pay, and accounts receivable are the amounts that we are able to receive from our customers when they pay us. Okay, so the next one is completed blueprints on a carport and billed the client for $1,900 for services. So we have a promise to pay from our customers of accounts receivable, and we actually earn the revenue. So that would be an increase to the asset and an increase to revenue, debit to the asset and credit to the revenue. We received cash, $700, so that's going to be a debit to cash. It's an advance from a customer to design a new home. So the advance would be unearned service revenue, which is a liability account because we haven't done the work yet. Received $2,800 cash for services. Okay, increase to cash, and we completed the services and delivered them to Mr. Svitlana. So it's service revenue. And we finally paid that secretary receptionist for the month, $1,500. So cash goes down and salaries and wage expenses go up. Debit to salaries and wage, credit to cash. And we paid $300 to Burlington for accounts payable that was due. So cash goes down and our accounts payable goes down. Cash goes down with a credit, accounts payable goes down with a debit. And in this exercise, I've only talked exactly what we've talked about here, except I know the debits and credit rules. I suggest you get some visual that you like. A lot of times, let's go back to the PowerPoint. And let me stop annotating. Clear, okay. Okay, now. This one. In your discussion forum, you're talking about how to better remember the rules for debits and credits. Some people say they put little acronyms of things like if you're a car dealer, or if you like to go to Vegas and you remember the word dealer, DEALER, and you put DEA equals LER. D is drawing, E is equity, and A is assets. They are increased with debits. Then the second syllable is LER. Those would be increased with credits. So L would be liability, E would be equity account, and R would be revenue. Whatever trick or whatever visual that makes this make sense, grab onto it, make your own notes on it, and have it in front of you while you're doing all of your homework. Even put them on flashcards and look at them occasionally, because the better you can get these rules down now, the easier this class would become. Even if it doesn't make sense, get the rules memorized. And then the rest, you have 2 more weeks in this class after this week, and then you have the next course, which continues on the same topic. Okay, so let's look at what the homework is all about this week. All I did, like last week, I went to, where's my, yeah, I just go to my home course, my course home. I'm going to week 2. And in week 2, I'm going to my week 2 assignment. And you have to do 2 things here. You have to download the template, which I've already clicked on, and I have it downloaded already. And you're going to, part 1 is to determine the account type, asset, liability, or owner's equity for each account name listed in the Excel workbook in the T account worksheet. Identify the normal balance. Is it a debit or a credit? And then part 2, you are given a whole bunch of T accounts, and these are the transactions that you're going to be analyzing. All of those transactions. and you're going to be putting them into the T accounts. So let's see what we have to work with. This is the file, and at the very top, part 1, identify the account classification. Is it an asset? Is it a liability, equity, revenue, or expense account? Those are the only things we want typed in this yellow section. Asset, is it a liability? Is it an owner's equity, revenue, or expense? Those are the only words we want typed in here. So, what is a cash account? Is it asset, liability, equity, revenue, or expense? And Nancy, you're still unmuted, right? She says asset. So she's correct. So for cash, you just type in asset. What is the normal balance? What increases this category? Debit or credit? Those are the only 2 words we want in this section of yellow here. And I know she's going to type in it's a debit. And then let's look at, yes, she did. And let's look at fees income. What would fees income be? Would it be an asset, liability, equity, revenue, or expense? Yes, it would be a revenue account. Very good. And revenues have a normal balance of a debit or a credit. Good, perfect. So this is what's expected in these yellow blocks. And when you have those down, then the second part would be to analyze the November transactions for your computer company using the T accounts. And we expect something in each one of these yellow boxes. So let's go back and just pick one. How about the first one? J. Joan visits her local bank and takes out $50,000 from her personal savings account. She creates a new checking account, a new bank account, and she puts her personal $50,000 into that checking account in the name of the business, $50,000. So what would we do with this? I don't know what happened there. Okay, so we have cash for the business increases by 50,000, I believe that it was. And Nancy?
And
Is
then,
that you?
yeah. And then under owner's equity, the capital would change.
Yes. So assets equals liabilities plus owner's equity plus revenue minus expenses. So that's exactly what you do for this entire homework. And then when you're done, you come down to what your total assets are based on your work, what your total liabilities are, equity, revenue, and expenses. Knowing that assets plus equals liabilities plus equity plus revenue minus expenses, which is exemplified right here in this line. And that's your homework. So is this, with some work, obviously, Nancy, is this something that would be doable?
Oh, yeah.
Okay. So do you have any questions?
No.
No?
Not really.
But if you do not lose confidence. Confidence kills. So instead of losing confidence, go back to the method of debits and credits that you understand, and participate in the other live sessions because they're going to be more question and answer type of sessions, and participate with the tutor. And this is the first big week in accounting, because this needs to be a solid foundation before we get to next week. And next week and this week's foundation will set you up for the following course. So these are important to basically, and I'm talking to you, Nancy. I'm also talking to all the classes. So this is important to actually get as your base, your foundation for the accounting experience. And if you can get this under your belt, you'll be really good and really competent to take on anything that this accounting course has to offer. So if there's no question, hang on, Nancy. If there's no questions, though, for this course, I will go ahead and stop recording.